How do traders do this? Is the question du jour. I mean by this. Well, by this I mean a few different things. First of all, how do traders lose most of their money in a very short time period? And the answer to that is usually they over leverage their positions. They get in poor positions, they have poor risk management, and they end up losing their shirts because they get wrecked. If you are enticed as a trader to do something foolish, like using high leverage to trade volatile assets on a regular basis, it is statistically just a matter of time until you are fully liquidated and have no trading capital left. How do we know this? Statistics. You don't have to be a genius to do this research and find it out. You can go to CoinGlass, take a look at liquidations in the last hour, last day, or whatever you want. You can see the different assets, for example, in crypto, where people are getting wrecked constantly, every single moment of the day. Just yesterday I saw that within the last 24 hours, somebody lost like $6 million on an ETH trade. $6 million down the drain because of a poor position. How could you do that? Well, if you're over leveraged and you're using bad information, namely lagging information, it's very easy to get wrecked, especially if you don't follow the 3 guiding principles of trading. Those guiding principles are: number 1, take profit early and often. Number 2, limit your loss. If you're in a wrong trade, if the trade goes against your entry, get out as fast as you can and wait for the next occurrence of opportunity. Number 3, don't be emotionally attached to your trades. The big high frequency trading firms have bots that do their trades. Do you think their bots have emotions? No, they don't. And nor should you when you're running your trades. Should you be an emotionless shell of a person in all things? No, clearly you're a human being. But when it comes to trading, you should not trade things that make you feel emotional. Trade things you really don't care about, or trade things that don't make you feel emotional, even if you care about those assets one way or the other. So that's one thing. The next thing is, how do traders make bank? Well, traders actually make bank by either working for a big firm that teaches them proper ways to trade using the highly relevant maths, like the means, the returns, right, the log returns of investments, the standard deviation of returns, which is volatility. And the most cutting edge ones now also use entropy. They use normal distributions. Some of them use Laplace distributions more and more. Basically, they use the same math that we use at Alpha Trading. Why do we use those maths? Well, we use those maths because they are the highly relevant maths of trading. That is why all the tools at Alpha Trading are built using those exact same maths. Log returns, mean, standard deviation of returns, etc. When I say the mean, I mean the mean of return, not the mean of price, because price is something that follows the returns. Price is a product of the volatility. Price does not determine the volatility. Price is the thing that happens after the volatility. So, that is how traders do this. And the other thing is, how do traders stay flat? And the answer is by not being in the market. You know, the old expression, it's not about timing the market, it's about time in the market. Well, that's as true for investors for the long term as it is for traders. If you're an active trader, that means you need to be actively trading. Sure, you could take some time off. And no, you don't always have to be in a trade. In fact, one of the key lessons of risk management is knowing when to not be in a trade. However, with the amount of assets there are on the markets available worldwide, there's really no reason, if you were in an active trading mode, to not get into a trade or a number of trades in any given day if you are a day trader. Like I said, are there days when you don't need to be? Sure, and weeks and months can go by when you don't need to be. It all really depends on your context. You gotta bear in mind that your context will differ from everyone else's, and you have to keep your best interest at heart. Your health, your wealth, your family, your happiness, all that stuff. Right? Those are the things that matter. However, if you trade for a living, you can't just sit around and do nothing and expect to make serious headway. Okay, maybe you deposited some money into some meme stock and it went up 500% without you trading it. Well, if you don't take your profit at some point, in all likelihood, it is going to mean revert, and you're going to lose your profits. So what should you do? Well, you should know how to read the VEPs, which is volatility, entropy, probability, and statistics. And then you should know when you should take profits. Like I said, you should take profits early and often if you're an active day trader. So not be greedy. Don't always try to get every last Satoshi's worth of a trade, or every last penny. Take your damn profits. See your returns are diminishing. You should take your profits. How do you know when your returns are diminishing? Well, you use a returns oscillator, or you use the alpha laser returns. And that can show you when your returns are diminishing. And when they are, you should probably take your profits. You can use volatility to show you, right? Once volatility, let's say you're in a long, and volatility has fully expanded, the correlation has fully expanded. At some point, it's going to break. Right? Yes, the volatility could drop, and so could the correlation, and therefore the price may keep going up. But more than likely, at some point, one of them will go one direction, and one of them will go the other direction, and price will begin to fall. So you should take your profits before that happens. How do you do that? Well, the answer is don't be greedy. Set your targets. You can use standard deviation targets, you can use Laplace targets, you can use VRE targets, you can use all kinds of targets. But use your targets, and when you hit your targets, take your profits. Why? Because that way you have more capital in your bag, more of that asset in your bag to run the next trade. And it doesn't matter if the price goes up, down, or sideways. What matters is that you have more capital with each trade. You want to win the overwhelming majority of your trades and not be like one of these fake TA gurus who tells you that if you win 20 or 30% of your trades, you're doing okay, and if you win 40% of your trades, you're doing fine, and if you're doing 50%, you're doing great. That's not okay. If you're not winning more than half your trades, you're not a winning trader. All right, think about it. If you're a basketball team coach and your team is only winning 40% of its games, would you say that they're a winning team? No, you wouldn't, because they wouldn't be a losing team. They'd be losing 60% of their games. Or if they're losing 70%, losing 80%, would you say they're a winning team? No, you'd say they're a losing team. So stop thinking that losing most of your trades is okay. It is not okay. It is in fact the opposite of okay, and it's the opposite of the point of trading. Unless your purpose in trading is to lose money, in which case, by all means, hey, knock yourself out if you have some reason to lose trades. If that's going to somehow make you money because you have some weird arrangement with some bizarre, eccentric billionaire who wants you to lose trades so they can do huge tax deductibles or whatever, then by all means, do that. But if, like 99.9999% of retail traders, your objective is to grow your capital base through trading by having a positive P&L, then take your profits. All right, that's what I have to say about that. Happy trading. Cheers.